Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. If you stick around this entire video, I'm going to show you why this recession could be more brutal and longer than anything you have lived through. And then at the end, I'm going to talk about how you can actually mitigate some of the dangers and the potential problems that we face. All right, sound good? Let's begin. Here we have it. Euro slides to 20-year low against the dollar as recession fears build. So now we are starting to go away from the inflation trade and going into a recession trade. And this is changing fundamentally what's happening in the markets. Now, what's going on with jobs, what's happening with the economy itself and the consumers, that's a different story. The markets react in their own way, and that's what's going on here. Look, the euro at parity with the US dollar seems so unusual just a little while ago, and now we're basically there, 1.029. This is important because it shows you a relationship of two currencies together. But when you see what's happening and you zoom out for just a minute, you start to realize that there's a race to the bottom. Which country will actually destroy the value of their currency fastest? And you look at what happened with Japan and you see what's happening with the euro. The US dollar is strengthening at this time. I'll show you that. But remember, this is in relation to each other. What's happening overall? I think it's pretty obvious, but you look at the price of goods and they have gone up considerably. Many factors, yes, I do understand that. But if you zoom out for a second and take the time to understand what's going on with the devaluation of currencies, with the central bank cycles, things start to make sense. Recession fear puts dollar on course for the biggest gain since 2020. You watch what happened during 2020. You look at what happened in previous crises. The US dollar, despite all its flaws, is seen as a safe haven, not just for people in the United States, but all over the world. And why is that the case? It's super liquid. It's the biggest market. It is the monopoly. It's the reserve currency. Everything is priced in US dollars. It is used all over the world. It's the most recognized currency today. That might change 10 years, 20 years, 30 years from now. But as of now, that's what's happening. And the more that yield that you're going to get from the US debt as an investor, if you're a foreign investor, even in the United States, the more yield you're going to get from those US debt products. Let's say you're going to buy a bond. Well, then it seems really attractive because would you rather buy Greece bonds or US bonds if they're going to net you the same thing at the end of the day? You might say, well, I'd probably want to stick with US. And that's what's happening. Money is flowing in. And you see the other countries around the world and what's happening with their currencies. I think it's pretty serious, okay? Look at this. This is what happened in the previous times, looking at it basically at the beginning of 2017 around this level, again in 2020 around this level, and now today the same thing. This just shows us going back. Haven't seen these levels for the euro since 2002. So this is pretty amazing to see the change, okay? Oil tumbles as much as 10%, breaks below $100 as recession fears mount. Real interesting, isn't it? Okay, now if I show you this, looking at it right now as I record this video, I'll refresh it just to get the latest data. You could see it is WTI at $100 a barrel. Now, just a moment ago, it seemed, you had this at $120 a barrel. And now things have really changed. Why? Because it's a recession trade. Oh, we're not going to need as much oil. We're not going to need all these things. So now that brings in deflation. You understand? So if we get into this mode of deflation, it's going to be a prolonged recession. But if we can make it quick, that soft landing they keep talking about, that's a different story. Well, some in the financial industry actually believe that once we enter recession, which is basically now, that marks roughly the bottom of the markets falling. Isn't that an odd paradox that once the recession begins, the markets go up from there? Nobody really knows, but I will keep track of all that for you. Hit that thumbs up button because that will indicate to the algorithm that you want to see more of this. You want to track all this. You want to know what's happening. See how I'm breaking it all down? I will do that in every single video for you, and I will continue to get better and better. That's my promise to you. Here we have the price of gasoline. I believe it's 21 days in a row, something to this effect, where it has gone down. Extreme, to say the least, okay? So this is across the US, but I mean, look at it over the last while. I mean, this is from 2020 up to the present. It's just been going higher, and that's putting an additional burden on people. The higher these gas prices go, the less people can afford, not just for gasoline, but for everything else. If they've got to fill up the tank because they have to get to work because they need that vehicle, they've got less money for everything else. This puts what consumers are buying down, less at the movie theaters, less at the restaurants, and so on. Natural gas soars 700%, becoming a driving force. Shortages of the fuel are rippling throughout the economy, threatening recessions and a further wave of inflation. Natural gas being one of those. The price of natural gas at any moment fluctuates wildly, but you look at this. This is in Europe. It's again spiking right now. Okay, so we've had these different bouts of shortages and problems and everything, but this has been the case. Now, one of the things I noted many times before, I want you to know if you're the first time here, that a lot of that gas is going from the United States. It's going off to Europe and it's being delivered there in order to help Europe out. They're dealing with that shortage. They've got issues with Russia and so on. And of course, that brings a real problem for the individual that's in these countries like Germany that are saying, yes, we do realize that, we really heavily relied on one country to supply the gas, but we're not so friendly with them right now, so you're going to pay more. That doesn't help people. Nickel prices surge as UK sanctions major Russian miner. So you see what's happening here. In this example, it's Russia. Remember the tariffs with China? Tariffs, sanctions, all of these things do not necessarily have a one-way impact. It's not saying, hey, we're going to go out there and we're going to hurt Russia. It's also hurting individual too, the individual in the UK in this instance. Okay, even if I have time, I'll cover it. But Japan, they're relying on Russian gas too, because what happened in 2011 with their nuclear. They don't have everything up and running, so they're relying on Russian gas. And what happens when you got a problem with Russia? Well then, and when you commit to basically saying we're going to go away from Russia altogether, and we want to do that right away, well then you've got an issue at hand, clearly. But this brings me back around. I want to thank you for sticking with me here. I'm going to talk to you about this. I've got a few notes I need to speak. The US market is all about pricing in a slowdown and pricing in the fact that the Fed is forced to hike rates into a slowdown. Okay, now L. Arian said this, and it is absolutely true. You're going headfirst into a brick wall. What will the result be? Probably going to be pain. And that's where we are at today. You see? We are doing something we know inevitably is going to end badly. The market's expectation, I believe I have this chart here, is that in the first quarter of 2023, less than a year away, we will see, believe it or not, we will see rate cuts. This has to be, I want to see the documents on this, but this has to be the fastest rise and the fastest cut that has ever happened, at least in recent history. If that's the case. And how can they get away with cutting? Well, they need to allow themselves enough breathing room. You see, they know a recession is going to happen. And they've got to get interest rates up high enough so that they have enough cushion. People need to, people need to realize that. They need to formulate a cushion so that when it's time to cut rates, it actually has an effect. Because if they were at 0, what would they be able to do? If it was at 0.5? No, they need to get that up to, let's say, 3%, so they can quickly start bringing that down and create a stimulative effect. Now, that would be the signal, of course. I'll give you one of those tips right now. The Fed changing course is a number one signal of potential increase in asset prices. And some are starting to suggest that will come sooner than expected. Okay? Look here, next one. I don't think, this is talking about recession. I don't think one is inevitable, but I think that a lot of it depends on what the Fed does. If the data suggests that the Fed should pivot from its current policy approach and they don't, then we have a problem. To me, that's the issue. The Fed has locked themselves into an aggressive tightening path, perhaps in a bid to avoid the mistake officials made during the start of 2020, when they labeled inflation as transitory. That's right. Remember that? They don't want to make that mistake again because their credibility is on the line. The markets believe everything the Fed says. You got to understand this. They believe everything. Market participants, the institutional investor, they hang on to every word. They screwed up 2020. They really did. At least we're talking, surface level stuff here. They screwed up. They do that again, well then maybe they won't listen to the next forward guidance that the Federal Reserve puts out there. Decades high inflation has particularly weighed on consumer confidence. Americans are facing near record prices at the pump and ballooning bills at the grocery store. Adjusted for inflation, average hourly earnings have fallen 8 straight months. That's eroding the purchasing power of the Americans. But hey, look outside. Look at Canada. Look at Australia. Look at UK. Look at other countries in Europe. You see the same thing, okay? People do not have the same wealth, or at least the appearance of wealth during that period of time. 2-year difference. 2-year difference made all these big changes when you think about it. And so what do we have today? We have an economy that is not strong. We have an economy that needs to have a jolt, an electrocution to get it back to where it was. And what is that? Well, of course, they're not going to do things that create real, long-lasting stimulative effects. So what will they do? They'll send paychecks to people. They'll do quantitative easing. They'll reduce interest rates, the standard fare. And during this period of time, the bottom 50% gets crushed. And of course, the top 1% and above will do very well. This, of course, shows us that what we are encountering here is something very unusual over a long period of time. Let me talk about a few things here. I wrote these down. The Fed is hiking into a recession. Employment right now, at unemployment rate, U3 unemployment rate, is at 3.6%. So according to the Fed's metrics, employment looks good. So this means that the Federal Reserve has room to move. They can continue on with this. They can go in this direction. But understand that we are in the most debt we have ever seen globally. Look at any country, most debt ever. Look at what every country had done. They brought their interest rates down to record lows. This creates almost like a beach ball effect, if you want to think about that. You push it down under the water. The further you push it down, the faster it pops back up. Reverse, same situation. I would be very concerned about this. High debt levels, very low savings rates, and people who are they have this insatiable demand for, what I see here as risk. And, I have some examples here, don't have time to get to it today, but just absolutely know that what we are watching right here is, we're going into a brick wall. How do I say it any differently, okay? But you as the individual, what can you do? Okay, number one, holding more cash than appropriate, particularly if you're not in the USA and you hold on to US dollar. This is going to give you an advantage if you're not in the USA. It's really strengthening at this time until things flip. And there's going to be a period in which you will want to deploy that capital. You look at all the influencers, they keep telling you dollar cost average, dollar cost average. Why? Because it's easy. It's easy, but easy doesn't get you where you want to be. The wealthiest people today that I've talked to and that they've talked to, they're hoarding cash. This is important. Okay. Next, trim your losers on bounces. The market comes up, you look at it. Hey, we got a little bounce up in here. All right, maybe now it's time to trim. I thought it was a good trade. Maybe it wasn't. Hey, let's take off that losses, okay? Off those losses. Invest in yourself right now. Knowledge, preparation, do what it takes. Now's the time to learn. Now is the time to acquire more skills. Skills that will be good today, but perhaps in the future. Don't get those skills that are outdated. Talk to your neighbors, talk to your friends. There's online courses available. Pay the money. If it costs a little bit of money, don't be afraid to do that because you're going to have that skill and you could take that into the future. Okay, I hope you appreciate all this information. If you did, simply hit that thumbs up button. Don't forget to join me right here on the 282,000 club, perpetually 282. I want to thank you for being here. Make sure you hit that subscribe button down below, and I'll see you on the next one. Take care.